Hello students. In this video we're going to look at some common adjusting entries. So from your reading so far, you're aware that at the end of the year you need to bring all of your accounts up to date, and specifically these would be revenues and expenses that you need to bring up to date. So a typical cause for an adjusting entry would be an unrecorded expense like the one we have right here. You purchased an insurance policy during the year, but it was a one-year policy. So when you bought that policy, it was an asset. The whole thing was an asset because the whole year was in front of you. However, by the end of the current year, you've used up some of those months out of a total of 12, so we need to record the expense. Now, I also would like to remind you that when you are doing adjusting journal entries, these will always have one income statement account, a revenue or an expense, and they will have one balance sheet account. The other thing to note, as is stated a couple of times in your module, is that adjusting entries never have the cash account involved. So if you find yourself doing an adjusting entry and you find yourself writing down cash, just go back to the start because cash shouldn't be part of your entry. So what I've done for this video is I've got 7 or 8 examples that are common examples of adjusting entries, and for each one, if there was a prior journal entry, I've already started by preparing that beginning journal entry just for your reference. You should be really good at doing these types of journal entries right now because you've had that practice already. So let's look at some adjusting entries in the area of an unrecorded expense. Now, the one I didn't put in here that I guess I could have is a very simple one where you just receive a bill near the end of the year. And if you receive a bill near the end of the year and you have 30 days to pay, then you still have to record that expense. So let's say it's a hydro bill that you get, and you get it December 25, and they're going to give you, let's say, until January 20 to pay. So you're just going to debit hydro expense and credit accounts payable. Now, we could think of that as an adjusting entry, but you've done entries like that before already. So let's look at some that we know are requiring an adjustment. First one, on August 31, we purchased a one-year insurance policy for $2,400. So a one-year policy, of course, is going to take us till August 31 next year, maybe August 30 next year. So when we bought that, it was an asset because we had not used any up yet. But let's look at what we've used. Now, I kept the number nice here. $2,400 for a year, we can divide that by 12, right? So if we divide 2,400 by 12, we're going to get 200 per month. So the question is, how many months of insurance did we use up? Well, not August because we bought it August 31. So let's say September, October, November, and December. 4 months. So 4 months at 200 is 800. So we know that we need a debit and a credit of 800. Now, again, we have to say we're using one income statement account and one balance sheet account. The balance sheet account is prepaid insurance because we have less. We've used up some of this asset. So that's going to be a credit. And as you can guess, our debit is insurance expense. So we have incurred an expense, and we're going to credit prepaid insurance. Now, I won't necessarily talk about this for every entry, but I do want to just remind you what we've accomplished here. We have put $800 into the insurance expense account, which means our income statement is going to be more accurate. But at the same time, we've taken $800 away from our prepaid insurance account. So you'll notice that the $2,400 less $800 is, 1,600. So our prepaid insurance is going to be on the balance sheet at 1,600, just as it should be. So we're always accomplishing a couple of things when we do these adjusting entries. So that was our first one. We're going to continue with unrecorded expenses for a few examples. So our employees are paid $20,000 per week for a Monday to Friday work week. January 1 is a Wednesday. Well, if January 1 is a Wednesday, then we have incurred an expense for Monday and Tuesday. So we need to say, well, what is 2 days worth out of 5 for 20,000? So if we take our 20,000 and we divide by 5 days, we get $4,000 per day. 4,000 for Monday, 4,000 for Tuesday. Our adjusting entry is going to be $8,000. And just like before, we have to say, well, what accounts are involved? And you've had journal entries similar to this before. So I'm just going to call this wages. We could have called it salaries. It's definitely an expense. Wages expense. Now, interesting, the credit account is not accounts payable. An account payable is for goods or services received on account. So that means external to your business. So this is actually going to be wages payable. So again, our income statement account helps bring the income statement into line of what it should be, and there's a liability that's going to be on our balance sheet. So let's look at supplies. We started the year with 2,600 of supplies, and we purchased 5,900 during the year. Now, at the year end, we count our supplies, and we don't count every pencil and every paper clip, but we tend to count full boxes of things, and we have $3,400 of supplies on hand on December 31. So we need to do an adjusting entry for that. And we need to say, well, how much is it? So let's look at this. We had 2,600 and we bought 59. So we could have used, this is what we could have used. We could have used all of it. So, whoops, what happened there? That's better. So we could have used $8,500, but we actually have $3,400 remaining. So the balance has to be $3,400. So what are we going to use as a credit? Well, it's going to be the difference between these two numbers, right? That's what we will have used. So I'm going to take my 8,500 and I'm going to subtract what's left, and we use $5,100 of supplies. Now, I didn't do a previous journal entry for this because you might have bought supplies all year long and you just are doing a year-end count. But we know that our supplies used up during the year is $5,100, so that becomes supplies expense. And we also know that we have fewer supplies. We have to bring our balance from 8,500 down to 34. So we're going to credit supplies. So let's look at another one, prepaid rent. So on November 1, we paid 3 months rent in advance. So let's first figure out what is that per month? Well, $4,500 divided by 3 months is $1,500 per month. So we started with an asset, prepaid rent, but we have used the facility for all of November. Notice it was November 1, not November 30. So we've used it for 2 months, and we need to accrue 2 months of rent expense. So let's just do that. going to have a debit to rent expense. And we have to credit our asset prepaid rent. Now again, $1,500 a month for 2 months, that's $3,000. And notice once again, our income statement account is up to date, and our prepaid rent account had $4,500. We just did a credit of $3,000. The balance sheet amount will be $1,500, showing the correct amount of that current asset. Okay, our last example of an unrecorded expense, we're going to look at depreciation. So we purchased equipment January 1 for $20,000. It has a 5-year life and a $4,000 residual value. Now we're going to be using straight line depreciation. Let's figure out what that is. You're going to learn a couple of other methods of depreciation in a later module, and you're also going to learn partial year depreciation, how to calculate part of a year in another module. So for now, we're just using a full year, and we're using the method everyone likes because it's so intuitive, which is straight line. So here's what we do. We take our 20,000 and we deduct the residual value of 4,000. So we have to take that away. And the difference between the two, I mean, I know you could do this in your head, but we're just going to do it here anyway. The difference between the two is 16,000. So 16,000 is called the amount to be depreciated. And we know that this equipment has a 5-year life. So let's divide. And that's 3,200 for a full year. So we're going to record a full year of depreciation. I'll spell it right this time. There's depreciation expense. Now you may take depreciation expense and a comma and go equipment, and accumulated depreciation, a comma, and write equipment. Notice that you do not credit equipment. You credit accumulated depreciation, which, as you read, is a contra asset. In this way, when we look at our balance sheet, it's going to be $20,000 for equipment less accumulated depreciation of $3,200. And the difference of 16,800 is going to be the net amount. And that gives our statement readers more information. So that's our $3,200. Okay, so those are some common unrecorded expenses. Let's look at unrecorded revenue. We usually have fewer unrecorded revenue, so there's just a couple here really. On November 17, we received $8,000 from a customer for work to be performed over the next few months. So we received money, but we didn't do any work yet. So we owe the work. So even though we received cash on November 17, there's a liability called unearned revenue, and that represents the dollar value of work we need to perform in the future. So this unearned revenue is a liability. Now, on December 31, we're going to say, well, how much did we earn? Well, it says right here, we earned $2,300. Usually a question like this, they will just tell you what you earned because you have to figure it out somehow. So they'll just tell you, we earned $2,300. Okay, so we know that if we earn $2,300, our adjusting journal entry is going to be $2,300. That's what we earned. And we earned it. So this liability, unearned revenue, goes down because effectively we have paid off $2,300 of this liability by doing work. So there's debiting the liability to reduce it, and then this would just be your revenue account, you know, cleaning revenue, service revenue, legal revenue, whatever it is. So I'm just going to say, for example, service revenue. So now we have brought our income statement up to date by adding to our revenue account, and we brought our balance sheet up to date by reducing the liability. And notice, you know, the difference on this is now $5,700 because we now have paid off or paid some of it through work. Okay, now here's a very simple kind of adjusting entry. It's simply we did some work and we haven't recorded it yet. So maybe we're really busy. Maybe we did this work December 28 and we go, oh my gosh, I did work December 28. I better put it on this year's financial statements. So you're doing your books and you say, okay, I better do this. And we're just going to record the revenue. Now this is, I'm assuming here this is on account. I probably should have written, did work for a customer for $3,000. Let's say on account. That's better. I didn't spell that word right. Okay. Anyway, so now we know it's on account. So here's accounts receivable. And here is service revenue again. Hang on here. Let's try that. Okay, and it was for 3,000. Pretty easy. There. So you're kind of used to that entry. All right. So our last example here. And in this example, we lent money to another company. So we're flush, we're doing well. We lent them money, we lent them $30,000. They have to pay us back in a year, and the interest is 8%. Now, the 8%, the quoted interest rate is always, without exception, for 1 year. So unless you're doing some weird thing with like credit cards and they say it's 2% per month, specifically say per month, you should assume that all interest rates are for 1 year. So we have to figure out how much interest we earned for 1 year. Now, we lent this money July 31. So let's first figure out how much a full year of interest is going to be. So the amount was $30,000. Now the formula for interest is principal, so P is principal, times R, which is rate, times T, which is time. So PRT, principal times rate times time. So here is our principal. Now the rate is 8%. So, you know, you could use 8% or you could use 0.08. It really doesn't matter, whatever you're comfortable with, but I just formatted this as a percent, so I'm going to use 8%. So what I do when I multiply principal times rate, I get that times that. Now notice that $2,400 is interest for a full year because 8% is the rate for a full year. So there are a couple of ways of calculating the portion from July 31 to December 31. You know, quite often in accounting, we allow students to round off to the nearest month. So when you see July 31, they're probably okay with you rounding off to the nearest month. In other words, we're going to charge August, September, October, November, December, 5 months. The other way to do it, though, is to count the days. So I'm just going to show you this on the side here. Let's just say that this had been given to the other company July 21. Well, if we gave it to this customer July 21, you cannot round to the nearest month, like no way, because banks don't charge interest by rounding to the nearest month. They charge by the day. So the other thing we would have to do is count the days. And here's what we would do. We would say, well, July has 31 days, and we lent the money on July 21, so 31 minus 21 is 10, so 10 days in July. Here's August with 31 days, here's September, here's October, here's November, and here's December with 31 days. So easy as anything, we would just say, okay, what is that in days? It is 163 days. Now this is just a what if. So we had, as you recall here, 2,400 is a year. I could take my $2,400 for a year, and I could multiply by 163 days out of 365. Now don't use 360. That's what people used to do in the dark ages when they didn't have a calculator or something. So 365 days in a year. So what we're going to do then is note that the T in the PRT interest formula is time. And because the rate is a year, time is specifically what part of a year? Well, the part of a year is 163 days out of 365. So we would simply go, take our 2,400 times the 163 divided by 365, and there we have it, and that would be $1,071.78 interest. So I just wanted to show you this as a little aside. You could do this. If you needed to calculate interest by the day, it wouldn't be that hard. Now our example is a little easier because we lent the money on July 31. So we need to accrue 5 months, right? August, September, October, November, December. Not July because we lent it on the 31st. So time in this case is 5 months out of 12, right? So the 8% is a year, so there's a year's worth, and we have 5 months out of 12. So the amount we want is our year's interest times 5 divided by 12. And that's $1,000. So easy enough, right? We're just going to take that $1,000 and say we earned revenue. Now, it's not service revenue, it's interest revenue. And remember, revenue is a credit. So my credit down here is interest revenue. And we know it's 1,000. So what are we going to debit? Now again, just like you saw before, this is not accounts receivable. Accounts receivable is money people owe us because we provided either goods or services on account. This is not on account. This was a note receivable. It's not goods, it's not services. So we can't call this accounts receivable. We need to call it what it is, which is interest receivable. Okay, so we have looked at quite a few adjusting entries. The examples here represent most of what you will see in your accounting course. So if you can do these, you can do all of them. Talk to you later.